Gary, now moving on to our fifth and final thing. As we mentioned earlier in the show, we have Cashen Crowe, DKI Intern, on as a special guest. He's going to walk us through our educational topic. Today, we're talking about hedging. So I know DKI has a lot of hedge positions in the portfolio. So, going to give a breakdown of that. Gary, thing number 5, I'll turn it over to you. Educational topic, understanding hedging. And introducing Cashen to the show.
All right, thanks, Rob. So you're right. The DKI portfolio is heavily hedged. We're trying to isolate very specific bets, very specific investment theses and areas, and to let our stock picking help us make money as opposed to just riding the beta of market expression or just the direction of the market. But the great news is Cashen Crowe, DKI intern from the University of Tennessee, is well prepared to explain to our audience. Cashen, how was your week?
It's going pretty good. Yeah.
Good. All right. And you're back. Where were you in Europe?
So I went to a couple different places, but I was in Spain, Germany, Czech Republic, Hungary, and Croatia.
Outstanding. Love to see you traveling so much. All right. So let's explain it to our audience in the most simple, direct possible way. First of all, what is a hedge?
So this week, hedging and investing, and this is essentially one way that you can use one investment to offset the risk of another. And a good way to think of it is kind of like an insurance policy. So you're using an investment, a different investment, and this would be you kind of paying that premium in exchange for some sort of protection. And you're never going to get an investment that's completely risk-free, but there are ways you can minimize that risk, and hedging is one way to do that. And here at DKI, we've laid out about 4 different ways, common ways that you can hedge investments.
Good. All right. I like the way you described that and also talked about the fact that it's insurance, right? There is a cost to this. It's not free. There's no free lunch here. You want to protect your downside, you have to pay something for it. I think it's a really good description. Okay, so let's run through the different kinds of hedging we want to explain to people today. And by the way, for our audience, there are dozens and dozens of ways to hedge, but we want to walk you through some of the most commonly used ones. So Cashen, let's talk about a market hedge. What would you do for a market hedge?
So a market hedge is when you're going to take a position that goes against the overall market. So one way to do this would be to short the S&P 500. It's a broad market index, and this is a way that you can protect those investments that are correlated to the market without having to sell individual positions. So yeah, a lot of times people are going to short the S&P 500, or maybe if you have something like a tech-heavy portfolio, you could short the QQQ, and yeah.
Good. All right. I like the way you described it. So what we would do in this situation is you would own an individual equity, an individual stock, or maybe a portfolio of stocks and say, I want to live or die with the performance of those stock picks as opposed to the performance of the market. So you would short the market against it. And you're right, you want to use an index that most closely matches the stock position or positions that you're trying to hedge the risk on. So I think that's the right way to think about it. All right, so moving on, what about shorting comparable companies? What would that entail?
So this shorting in comparable companies would be where you try to find another company that's highly correlated to the position you're in. And this is also referred to as pairs trading. But for example, if you're bullish on a certain company, let's take AMD for example, a semiconductor company, and you want to isolate the strengths of that company, um, but you're worried about overall threats to the industry, maybe the semiconductor industry, you could short a comparable company like Intel, and this short position could offset the overall risk that AMD is going to face in that industry, but you're still getting the potential for AMD to have returns due to those specific strengths that you're trying to isolate.
Exactly. Great description. Now, for people who are, coming at this for the first time, one of the risks in this is if you make the wrong choice, you could end up owning the company that underperforms and being short the company that outperforms. There's no guarantee that it's going to work. And, we just saw recently Intel, they had, new management team. They also announced plans to potentially spin off some divisions or restructure in ways that would make sense. So if you would have had that specific pairs trade on at that time, you could have ended up losing more money in the short than you'd make in the long. And so it's a great strategy, but you really need to get the research right on that one. Is that sound fair to you, Cashen?
Very.
All right, let's talk about another great way to buy insurance, buying put options against your long positions. What would that entail?
Yeah, so buying put options on your long positions is definitely a very common hedging strategy. Like we mentioned, insurance, I would say this is a better example of insurance because it's a way to buy that personal kind of insurance protection on a single position. And this would be where you're basically long on a position and you're going to go ahead and buy that put option that is going to protect you in case the stock in which you own goes down in value. So if it goes down, and as that put option moves closer to the strike price, you're able to capitalize off of the negative return that the stock may experience. So investors using the strategy can still collect gains on their stock. It's not going to be, well, there is still a potential that you're going to lose money, but there is a way that you can still experience gains even if the stock goes up and the put option declines in value.
Exactly. So in that scenario, if the stock that you own goes up a lot, you'll benefit from that, but the put option, that cost is going to be gone, and that's all right. You're buying insurance. The nightmare scenario on this particular way of hedging is, let's imagine a hypothetical situation where you buy put options, say 10% out of the money. So your stock is at $100, you buy 90 strike put options, and if the underlying equity, the stock maybe goes down to 90, 91, 92, you can lose money on the long and have the cost of the put expire worthless, meaning you bought insurance, didn't benefit from it, lost money in both places. That's the risk of it, but this can be a very effective way to limit risk, especially on large long-term positions, right?
Exactly, yeah.
All right, great. Now let's go to a fourth way of hedging, and something that we do in size at Deep Knowledge Investing, buying uncorrelated assets. What would that entail?
Yeah, so a lot of people like to diversify into these uncorrelated assets, maybe even negatively correlated. And these are assets that don't move in sync with much of a portfolio. You have stuff like Bitcoin, gold, other commodities. A lot of people like to invest in these when the market may be going through a rough patch because they're able or have proven to be able to perform well during periods of high inflation or market panic. So this is mitigating risk by reducing your overall portfolio volatility, and it can give you a chance to experience gains even when the overall market is going downhill.
Exactly, right. So at Deep Knowledge Investing, we own huge amounts of Bitcoin, we own gold, silver, uranium, other forms of energy. Basically, when I wake up in the morning, I'm focused on the specific news of the companies or assets that we own. I don't spend a lot of time worrying about whether the market's going to go up or down. So buying uncorrelated assets is a great way to make money in positions that don't necessarily depend on the market. Sounds good. All right, Cashen, any other thoughts on this?
No, I think that's about it.
All right. Well, by the way, for our viewers here, for anyone who actually is reading the written version of the 5 things, which we distribute to premium DKI subscribers on Monday and to the free subscribers on Wednesday, you're more than welcome to go to deepknowledgeinvesting.com, sign yourself up for a free or paid subscription. But I want all of you guys to know that on the written version, it was Cashen who wrote this part of it. He's the one who put together the graph, the image for it. So, it's our young interns who are doing this kind of work and doing, in my opinion, a phenomenal job. Cashen, great job on this. Really great to hear from you on this.
Thank you so much.
Awesome stuff. Cashen, great work. Pleasure to have you as a part of the show, as always, and looking forward to having you on a future show coming up. For everyone else, that concludes this week's version of the 5 things, the Powered by Nuclear Power issue. Gary Lovin throwing in all those powers in one title.
I did that on purpose.
That's right. That's right. Be sure to subscribe to our YouTube channel. Head over to our website, deepknowledgeinvesting.com. You can sign up for a free subscription. That will get you notifications on all new content being published on the site. And as always, would love if you would consider a premium subscription. That'll ensure that you do not run into any gated content on the website.